Auditor independence is a fundamental principle of corporate governance and professional auditing because it underpins the credibility, objectivity, and reliability of audit opinions provided to shareholders and other stakeholders. The primary purpose of an audit is to provide independent assurance that financial statements and governance processes present a true and fair view of an organization's financial position and performance. This assurance is only meaningful when auditors are free from bias, conflicts of interest, and undue influence that could impair professional judgment. Within the program, auditor independence is recognized as an essential safeguard for investor confidence, market integrity, and effective corporate governance. Independence protects the public interest by ensuring that audit conclusions are based solely on objective evidence and professional skepticism rather than personal relationships, financial interests, or management influence. Consequently, organizations and audit committees must establish governance arrangements that preserve auditor independence while promoting transparency and accountability. The concept of auditor independence applies to both internal auditors and external auditors, although their organizational relationships differ significantly. Internal auditors are employees of the organization and therefore require organizational structures that enable them to perform their responsibilities objectively despite their employment relationship. External auditors, by contrast, are independent professional firms engaged to express an opinion on financial statements and governance disclosures. In both cases, independence requires auditors to exercise impartial professional judgment free from personal bias or conflicts of interest. The framework emphasizes that internal auditor independence is necessary to ensure work is carried out objectively, reinforcing the importance of organizational safeguards that protect the internal audit function from executive influence. To preserve independence, organizations should implement several structural safeguards within their governance framework. The program identifies 4 principal factors that protect internal auditor independence. First, the internal auditor should be independent of executive management, ensuring that operational managers cannot influence audit findings or restrict audit activities. Second, the chief internal auditor should report directly to the audit committee, rather than executive management, thereby reinforcing organizational accountability and strengthening governance oversight. Third, the chief internal auditor should have unrestricted access to the chairperson, enabling significant governance concerns to be communicated directly to board leadership without executive interference. Finally, the audit committee should approve the appointment and termination of the chief internal auditor, preventing management from exerting inappropriate influence through employment decisions and preserving audit objectivity. Together, these governance mechanisms enhance the credibility and effectiveness of the internal audit function. Auditor independence is closely linked with the concept of professional skepticism, which requires auditors to maintain a questioning mind and critically evaluate audit evidence throughout the engagement. Professional skepticism prevents excessive reliance on management representations and encourages auditors to investigate inconsistencies, unusual transactions, or potential indicators of fraud and misstatement. Independent auditors therefore contribute significantly to organizational accountability by providing objective challenge and critical assessment of management information, internal controls, and governance processes. Without independence, professional skepticism may be compromised, reducing audit quality and increasing the risk of governance failure. The program identifies several potential ethical threats that may impair auditor independence or create the appearance of compromised objectivity. These threats apply to both internal and external auditors, reflecting the importance of maintaining ethical standards across all assurance activities. The first threat is self-interest, which arises when the auditor possesses a financial or personal interest in the client organization that could influence professional judgment. For example, an auditor holding shares in an audit client may consciously or unconsciously avoid issuing an unfavorable audit opinion to protect personal financial interests. Such conflicts undermine stakeholder confidence in audit independence and professional integrity. A second threat is self-review, which occurs when auditors are required to evaluate work that they previously performed or contributed to creating. Reviewing one's own work reduces objectivity because auditors may be reluctant to identify deficiencies or admit previous errors. Self-review threats commonly arise when audit firms provide both consulting and assurance services relating to the same systems or financial information. Effective governance therefore seeks to separate advisory and assurance responsibilities where possible to preserve audit independence. The third ethical threat is familiarity, which develops when auditors become excessively close to management through long-standing professional relationships. According to the framework, auditors may become too friendly with the client after working with them for a number of years, potentially reducing professional skepticism and willingness to challenge management assertions. Familiarity threats may therefore be mitigated through audit partner rotation, independent review procedures, and periodic changes in audit personnel that maintain professional objectivity while preserving audit quality. A fourth threat is advocacy, arising when auditors promote or support the client's interests or opinions rather than maintaining impartiality. Advocacy may occur when auditors represent clients in disputes, marketing activities, or negotiations that compromise their ability to provide independent assurance subsequently. Closely related is the intimidation threat, where auditors experience actual or perceived pressure from management, influential stakeholders, or clients seeking to influence audit conclusions through coercion, threats, or commercial pressure. Such intimidation may discourage auditors from reporting control weaknesses or financial misstatements objectively, thereby weakening governance effectiveness and public confidence in audit quality.